Loud. Good evening, everybody. It is March 31st, 2020, the end of the quarter, and what a quarter it has been. This is the worst quarter in a long time. I don't even know what year this goes back to, if it's 2008 or 2002 or 1 or 0, but it's been the worst quarter in a long time. Not for good reasons, but as I pointed out in a number of articles, we were going to get a substantial correction anyway this year. I don't know that it would have gotten any worse than it's already been, and probably wouldn't have been as fast without the coronavirus. What coronavirus did is accelerate the speed and timing of the downturn, as well as probably the severity. Now, we don't know if this is going to get more severe, but if you read my article today, I strongly think that it probably will. I don't think that the nation is ready, and I've talked to a couple people in other places of the world. I don't think America is ready for what's about to hit. We've been talking about it. It's been in the news. But until the last couple of days, the message out of Washington wasn't quite as hunker down and get ready as you thought it maybe should have been. But suddenly in the last few days, the messages since Sunday morning, I was watching Dr. Fauci on CNN Sunday morning when he said, yeah, we're expecting 100,000 to 200,000 deaths if everything goes right. That's brutal. So all the folks who were saying, hey, this is just a flu, I hope they've woken up now. The basically keep to yourself recommendation from the White House has been pushed out to April 30th. Stafford Act has been in effect for a couple of weeks to help you get FEMA to the states. And I think in the next few days, if the curve at Johns Hopkins doesn't turn down, we're in a world of hurt. So if you haven't taken a look at this website, and I use one of the charts in today's article, on the bottom right here, you're going to see the curve for the number of cases. And you see that it goes up like this, and that looks a little scary, but if you look, it just is starting to bend, indicating maybe a top. So what you do is you take a look at the logarithmic scale, which takes out the exponential look of the curve, and you really are able to focus more on the rate of change. And right here at the end, either this could be just a little head fake, could have something to do with testing anomalies, it could either be getting ready to bend up. If this bends up, this is horrible. We really need this to flatten in the next 2 weeks and then turn over. And we need it to be like the chart that I showed you last week. That this guy, medical researcher, we need the curve to be like this green line. And right now, we are right here. Which way do we go? Does it keep going up like this, or does it turn over? And we have people in about 20 states that just aren't taking this as seriously as they should, in my opinion, and we still have too many flights going on. So I'm not convinced that we're going to get the green line. I think maybe we don't do as bad as the red line, but I think there's something in between that goes all the way out into May. And it ends up being much worse than it needs to be. And if this red line or something close to the red line happens in the next 2 weeks, then for sure the government's going to have to shut the country down. So we're hoping that we don't get anything close to the red line. But I suspect we'll be closer to the red than the green, because the mitigation, the whole month to 2 month shutdown, we just haven't done yet. And there are states that have, but the rates of infections are going up everywhere. If you take a look at this, You can get the chart for each state. I don't know how to get it, but you can get it. And it's just brutal. So hopefully we turn this curve over. I'm not really sure that's where we're at right now. In any case, that's why I'm not particularly excited about the stock market right now. I know a lot of people still have it in their head, especially some of you younger investors, still have it in your head that, hey, this is the dip to buy. And it probably is not. So in today's article, I wrote about different factors that could cause the stock market to go lower. And I hope that that's not the case, but it probably is. And I'm just telling you what I think is something that you ought to have at the top of your list. So today's article was investors haven't capitulated yet. Already, 82 comments. Are we trending? Are we the trending article? No, we're not even a trending article. Get out of here. Everybody go click it. Let's trend. Anyway, there's 80 comments on it already. About 20 are mine. I want to show you, this is the chart I just showed you. This is the chart that I put out over 2 years ago now about where we could be. So this was the first correction in 2018. We've since got down to almost here. So everything that happens here. This is the first correction, December 2018. This is the more serious correction that I pointed out. And then this is the what if there is a shock or a crisis sort of thing. And we're about here now, a little above it. We got a little bit of rally. And the question is do we come all the way down here? What we should be concerned about is that the earnings on the S&P 500, this is what happened during the financial crisis. So this idea that companies can't all earn nothing for a year or two is wrong. They certainly can. The idea that earnings don't crash down to zero in the next 2 quarters and then not come back until the 4th quarter and even into next year is fantasy. Unfortunately, not only could companies have zero earnings or negative earnings this year, but this is an aggregate. This is the S&P 500. The S&P could have no earnings this year and potentially only get about halfway back next year. Instead of this huge rally that we had in 2009 and 10, really 2010, it might take 2 years. It might take 2021 and 2022. Why? Because we don't know if there's going to be rolling pandemic here. We don't know if there's going to be 2nd and 3rd waves. And there certainly could be. So the average of the 4 valuation indicators that we've been looking at, well, we're down here at the 2nd red line down. We're not undervalued yet. We need to get all the way under this first line to be fairly valued. And at about 2,200, so for a hot minute, we were almost there. You know, to get down to undervalued, we'd have to go below 1,700 on the S&P 500 to get down here. So I don't think that this is going to happen just because of all the monetary firepower and fiscal stimulus. And there's more coming. They're already talking about it. But we should expect to get into this area. There's no point in doing all this if the stock market doesn't at least reset to where price discovery and valuations matter again. If price discovery and valuations don't matter, then you might as well just go to the casino. And as a guy that's good at a casino, trust me, it's crossed my mind. So I put the Yusko thing up here again. For whatever reason, this chart doesn't pop out anywhere I put it. But where I think we are is in the bull trap. We had our first drop down, fit of denial, bull trap, a little bit of a rally. I think we get another leg down. Now, I don't think the second leg is that much bigger in degree than the first leg down. That first leg down was pretty severe. So really this hook right here is probably down here. And we just have to get into fair value and possibly undervalued. And undervalued would come from this being bad. I don't think if this curve turns over in the next 2 to 4 weeks, I don't think that we go under 1700 on the S&P 500. But if this curve turns up and it ends up being close to this red line, then we got problems. We could see the S&P 500 go all the way down to about 1,000. Now, the bear market low in the financial crisis was much lower. I'd have a hard time seeing that occur under really any circumstances other than massive war. I only think a war can cause this now. But I think we can approach this support level, because after the financial crisis, we rallied, then came back and tested this level and almost tested that level again. So going all the way back to 2010, 11, 12, or almost to 2010 and 11, that's the support level, right around 1,000, 1,100 on the S&P 500. And the fact that a lot of people don't think there's any chance this can happen means that there's a chance that it can happen. You know, people are talking about this level here, the one that we hit. I mean, look at where my lines were. I mean, these lines were, you know, right on the money. So look at where we had these. You know, these are good lines. I mean, these are good support levels. They make sense. They don't play with a lot of small numbers. It's just the big ideas, the 30,000 foot view. But these are where the big support levels hit. Broke through the resistance, came back down, retested it, and then broke out on the tax breaks and deregulation. And now we're coming back down. This level here, 1,600, 1,700, 1,800, 1,900 on the S&P 500, somewhere under 2,000 makes a lot of sense. You know, can you get all the way down to here, marking the double tops, right? Just around 1,600, it could. So these are the two levels that I think we really need to be watching. So I'd probably start buying at the top one and then really load it up here. Unless we just think the world's going to hell in a handbasket, and we'll have to make that a game time decision, you know, then maybe it gets all the way down here. What I want you to take a look at, though, is this is a monthly chart. And notice that when we get this oversold, when the market gets this oversold, August of 2002, March, February of 2009, you generally need to buy. So we'll know tomorrow if this got all the way down here. I mean, I haven't even checked. I'm sure I could check right now. But we'll see if this gets all the way to oversold. I think April is when it hits oversold on the monthly, which means we need a basket of stocks to buy. Glad you asked. I've got one. So you've seen my top 10 lists of growth stocks and dividend stocks, the 12 must-own stocks. Here's for you growth investors. What I want you to consider is this idea. Companies that are not in the S&P 500 that grow and become profitable, those are two of the criteria to be in the S&P 500, have to be of a certain size. Right now that size is about $9 billion. And you have to have been profitable. I believe it's for 4 quarters in a row. And there's some other criteria. And you got to be domestic. And there's a couple different ways you can fulfill that. You have to be on one of the 4 big exchanges. You have to make most of your money here, or at least be domiciled here. There's a lot of rules, but basically it boils down to, are you an American company by some definition, and are you big enough to be in the top 500 companies, and are you profitable? Those are a criteria to be on the S&P 500. As I have told you over and over again, my research, and I'm going to start submitting these as short ideas to Seeking Alpha Pro, as well as selling the institutional research. I just sold a short idea to an institutional investor, and they bought it. They paid me, and that stock dropped 30%. you know, like a week later, 2 weeks later. And part of it had to do with coronavirus, but, you know, whatever, they made a bunch of money. So we're going to find more of those. And I will give those to people over at Fundamental Trends. Margin of safety investing is not designed for shorting stocks, but Fundamental Trends, that's why I gave the folks at Margin of Safety the add-on. You know, if you want the add-on for if you're a member at Margin of Safety Investing and you want the $99 add-on to come on over to the swing trading room at Fundamental Trends, have at it. It's $99. I'll give it to you. I just want to keep the two things separate because the margin of safety is more about being a long investor and having a great asset allocation. So these stocks can go into an asset allocation whether they're Fundamental Trends and a little bit more aggressive, or a margin of safety and not so aggressive, because these are growth stocks that aren't yet in the S&P 500. And again, why is that important? Because when they get added to the S&P 500, they get all, first of all, they were growing to get there, right? So that's great. But second, then all that index fund money gets poured into these stocks. And that essentially creates a new support level for these stocks. I mean, it is very hard for them to go below the level when they first get into the S&P 500. So, title of the article is 12 Great Growth Stocks, not in the S&P 500. And then I'm going to amend this, but could be soon. And there's not really 12 stocks on this list yet. There's only 10. There's a bunch of stocks that I'm looking at. I just haven't had the time to do the research on all of these yet. It really does take some time. You know, when I research these companies, we're talking weeks and weeks usually of reading corporate documents and studying the industry that they're in. Because there's a lot of overlap in the industries, I'm starting to build some knowledge about some things that maybe I've fallen a little bit behind on a year ago when I was recovering oil addict. But, you know, back to my roots from the 90s when I was a tech guy, some of these companies I think can be on this list. If you have worked with any of the companies on the list that we'll go through in a second, or any of these, let me know. And let's write a strengths, weaknesses, opportunities, and threats report, a SWOT report. You know, these SWOT reports are excellent. And these are companies that, you know, I've actually had a Ring Central phone number for years. I don't anymore, but because I switched over to Google. I just like the integration of all the Google stuff. DocuSign, TD Ameritrade is using this. I was using DocuSign before it was public, when I was with a different brokerage. ST Microelectronics, I believe that's testing equipment for semiconductors. Seattle Genetics, Dexcom, both biotech. Tal Education. Do you think we're going to see a surge in at-home education? Do you think a lot of school districts will go hybrid, where it's come to school some days or come for half days? I think that we're going to see a change in the education system. Zoom, right? We're on Zoom right now. So I'm familiar with a bunch of these companies. I just haven't done the deep dive. These companies, I have done the deep dive. So here are the companies that could make it to the S&P 500 in the next few years. And I'm going to start with my favorite company, which also happens to be the smallest, Enphase. Solar and energy management is one of the fastest growing industries on the planet. Depending on whose stats you read, it could be the fastest growing industry on the planet. It's a little volatile from quarter to quarter, but year over year, it's growing very fast. These guys, their technology is great for small and medium build-outs because it's just snapped together. Take a solar panel with Enphase built right into it, boom, snap it onto the next one. So it's just like, I don't know, things that snap together. But, you know, there's a toy to this extent. Like Legos. So, have you heard of Legos? So I like Enphase. It's my favorite. If you can buy these guys, sell puts on them, whatever, I think that this is a company not only that you can own for the long term, but you can trade it. Square. I have talked about Square in the past, and I backed off because they got overvalued, and now they've come way back. Between the fintech, the Cash App, the merchant services, right? You swipe your card, somebody using a little Square and an iPad, peer-to-peer, crypto, and they have the link up with Twitter, right? Jack Dorsey. He's the CEO of both companies. I think the Square and Twitter are going to start getting pretty competitive with Facebook and LinkedIn. And then they're going to have the Twitter app. Think about the things they can do down at Twitter with monetization of media. And Square, I don't know how they put things together, but there's a lot of things that make sense to me. Shopify. This is a company that helps other companies not get Amazoned. In the era of order out and stay at home and just order it, right, which we're all getting used to now, how many of you, I kind of like to see the show of hands button, how many of you have ordered groceries to either pick up or get delivered here lately, right? Shopify does a bunch of that. So, Kroger's a company I'm looking at now that Buffett's bought it, and I have a deep understanding of the company for one of the dividend lists. But Shopify, Tesla. You heard of Tesla? There's this guy named Elon Musk, makes an electric vehicle. He's got battery technology, solar technology, all these fast-growing markets, and he's hooked up to some of the richest people in the world, so he never goes broke. So he's been able to build this business and intermittently been profitable a couple times. And granted, I think that there's some shenanigans with the profitability. I don't really think they've been profitable, but they've been close enough that an accountant can make it look like it. Is the market cap correct at $108 billion? Who knows? Something that you need to be aware of is all these traders over on Reddit, these little millennial traders. I call them little millennial traders because most of them have been getting their ass kicked the last month. But and they still don't. They still just want to FOMO. I don't want to miss it. I gotta buy it. That's one of the reasons why I think this market is going to keep dropping, is because there are people out there buying things that they don't understand. That's never a great idea. Should Tesla be worth $100 billion today? I don't think so. I don't think it should be worth more than $20 or $30 billion, maybe 40 or 50. But it's at least double what it should be worth, what its real value is in, near-term earnings. But it's probably more like triple. It probably should be back down to 200-ish. That's the price where we first bought it, under 200. And it should be there if you're just looking at the fundamentals. But, of course, fundamentals aren't the only thing that matters until it does. So, the Reddit guys keep pushing this up because they can manipulate the market enough to get it pushed up. So when we make our trades, we want to be very careful. We want to go check out that Reddit thread. I forget what it's called, Wall Street, whatever it's called. We need to check out those threads just to make sure, are they engaged in some sort of pump and dump? And really, they are doing pump and dumps in public. If it was, I've told you, if it was professionals, they'd be in jail. But they get around it somehow. But Tesla's been a manipulated stock, and I think that we can make money on it, but we just have to be careful not to catch a falling knife if at some point they see how far they can beat it down, which I think some smart kid will, right? Some smart kid or smart kid who has an uncle at a hedge fund or, a buddy at a hedge fund or whatever. They're lying, cheating, and stealing somehow. They'll push Tesla down as far as they can, and then all the Tesla haters will come out of the woodwork and say, told you, Tesla's going to zero. And it's not, because then those Reddit guys will go, they all sold it. Let's buy it back and push it up $1,000 again. So just understand how the game's played. It's sick, it's demented, and it's a lot of fun. But you just have to be careful that this is one of the manipulated stocks, and we don't know which one's going to be next. Roku, I have a Roku TV, have two. Love them. I think that these guys are awesome for the cord cutters. We're figuring out all kinds of things how to use this properly. I like it better than Apple, better than the Google one. Amazon Prime you can put on the Roku. The Roku is just a platform, and the only one it doesn't play nice with is Apple so far, and which tells me that Apple might just buy it. But I do think that this one's just going to keep making more and more money. The way they do commercials, the screen stuff, it really is outstanding. Teladoc. Do you think that more people are going to use FaceTime or Skype or whatever their app is going to be called to talk to doctors, right? These guys are really big with group health plans, and they're moving it out into the individual stream. And what happens if we end up having Medicare for all in the next 2 or 6 or 10 years? At some point, this becomes part of the whole efficiency thing with healthcare. So I really like Teladoc. They're not that big yet. They're just barely big enough to be in the S&P 500. They're making money. I'd have to double check, but I think they're going to be in the S&P 500 soon. PTC, Industrial Solutions for Technology, Internet of Things and augmented reality. If you're a skilled tradesman or you know them or you know who they are, think about some of the tight spots that skilled trades guys have to be in. Or where they have to be, on top of buildings, in basements, stuck between buildings, in ditches, on towers, whatever. They can't, they don't know everything, and they have to consult from time to time. What if they could have a goggles, and they could just talk to their goggles, and it showed them what they needed to know, right? They actually have it now. It's getting cheap enough that everybody's going to have it. These guys are part of that revolution. And then all sorts of other industrial applications. So as industry becomes more machine than man, PTC is going to make money. Workday, SaaS, for medium and large business. These are the guys, and I remember these guys from the early 2000s with PeopleSoft, actually from the late 90s, early 2000s for PeopleSoft, and Oracle bought them. So this is another great company with smart guys, and I think Oracle is going to beat them. Not beat them. I think somebody's going to buy these guys. It just makes that's the DNA of these guys. They create a great company and they sell it. I think Workday also gets bought out at some point. Twitter, again, I think that platform is just in the early phases of being monetized, and what they can do with media going forward, I think, is pretty off the charts. I think they can, compete with Facebook. I don't know if it'll be quite as pretty as that, but I think there's a way for Twitter to expand even further. All these people are on Twitter now. Honestly, Donald Trump has been great for Twitter. I think and I will say this, Jack Dorsey has impressed me with his ethics in a way that Mark Zuckerberg never has. So at some point, you got to think that maybe he's rewarded for that. But I think Twitter has big upside. And again, I think there's synergy between Square and Twitter. And honestly, I don't know. I did put these in rank order, and maybe Twitter should be a little higher. I just think their execution risk is a little bit higher, right? And then Zendesk, think about the work-at-home economy. These guys are part of that whole revolution of connecting people on platforms so they can communicate, whether it's customer to business, business to business. Zendesk is going to be in all that stuff at some point. So they're growing pretty quick, 7.2 billion. Another asset light, non-capital intensive business. So if you're not capital intensive, meaning that as you get more subscriptions, you make more money and you don't have to add that much in expense, right? That's a great margin. So these 10 companies are right now the 10 companies I'm looking at. I think 2 more are going to come from this list, maybe 3, I don't know. But there's a couple more. To be on this list, you can't be in the S&P 500 already. So if you're asking about a company, double check to see if they're in the S&P 500, and if they're $50 billion, in most cases, they're not on here anymore. Shopify and Tesla are exceptions. They just haven't hit the profitability thresholds, and they're about to. So for sure, Shopify and Tesla will get added to the S&P 500 at some point. Square will, Roku, Teladoc, I think PTC. I mean, I just can't see them not growing more. Workday, really all these companies, they're basically the right size, with the exception of Enphase. Now, Enphase has a much longer up ramp. I do think this will be a $100 stock in the not too distant future. So I like it because I look at it as a triple or quadruple in the next few years. So let's take a look at just a couple of charts and then we'll call it a night. I want you to really understand and embrace what I have told you about how to read these charts. This is about as easy of charting as you'll ever get. And I use Elliott Wave, and I use Fibonacci's, and I use 10 other indicators, 10 other ways of charting, and I just look at other people's charts. And then I overlay the money flow on everything. I'm telling you, the simple economic truth of money flow is this. When money is going into an investment, it's much more likely to go up than down in price. When money is coming out of an investment, it's much more likely to go down than go up in price. Why? Pretty simple math, right? Supply and demand. Money going in or out represents demand. If demand is going down, money going down, price goes down. Holding supply of stock relatively constant in the short-term frame. So if you look at the weekly chart for Square, this is a really nice consolidation. And it just, got whackered today, I believe, right? Did it get whacked today? Is that down $30 today? Whoa. So here's a candle down. Then here's one of the lines I drew. This is, could this stock get into the teens? Could. So if it gets oversold on the weekly and the money flow bottoms out and the momentum bottoms out to the downside, then you flip over to your daily chart. This is the weekly, right? Just came off weekly. Just go, okay, as I say, no, that was a monthly chart that went down that much. Okay, that makes more sense now. But as these weeklies, right, get down to the bottom, then you start going, okay, the weeklies are way at the bottom. What does the daily say? Well, the daily is kind of in the middle, but heading down. So we have a little waiting to do, 2, 3, 4, or 5 days maybe. Right? This really measured 5 days. This measures 5 days from one end to the other, usually. So in the next few days, if this gets down in here, we have to start looking at it, especially if the weekly gets oversold too. So when the weekly gets down here, and then the daily gets down here, that's when you look to buy. Now, on a lot of older liquid stocks, you have to look at the monthly as well. But in general, the weekly chart, oversold, negative cash flow, and, well, this is a crummy looking chart. But with the indicator for momentum crossing back up, so this is, yeah, that's a confusing chart. So I think this has a bit of a way to come down here. It should bend over. This should come down, and this should come down. So you might see this all the way down, right? Go back to your weekly chart. Say, okay, where's my real hard support? Go out to the monthly chart. Man, could this really get into the teens? I don't think so. I think that this other stuff makes more sense. Yeah, but it broke that level. This stock, if you take a look at Square, right? That's a support level down there around 16. Because it had such a smooth ride up, you can look at these and look at the cloud formations. There's ways of doing little clouds and other things. This looks like it could just fall through the floor. And if it does, you ask yourself the question, is it going to stay in business? And I think the answer is yes. So if this comes down to 20-ish, upper teens, man, you got to jump all over that. Now, if you want to throw out the big picture, start going to shorter and shorter charts. Go down to 4 hours. Where are they on the 4 hour, right? And you could try to trade this. Go down to 2 hours. Go down to 1 hour. Go down to 1 minute charts. You can do that, but the shorter the chart that you do, the shorter the time frame you're trading. So since we want to hold these for 6 months to many years, we really want to find one of those oversold spots. And it came off, right? The last week it came off. But it just looks like it's getting ready to turn over again. Look at the way that looks. Doesn't that look like it's turning over to you? So if it does, it gets back down here, what price will that represent? Was this the price? Is it going to get down to $32? Is that where its low is going to be? Is that a retest? Or is that just on its way down to 20-ish? Right? We have to be careful with that. But that's what this is telling us. Keep an eye on money flow, because if it keeps going down, you really need to wait till it's oversold. And then let's take a look at end phase. Again, not another chart, another chart with not a lot of history. So when this crashed the first time, a few years ago, I was looking at it when it was $1. And I didn't buy it until it did that. And then that. And I got part of that gain. But I should have bought it at $1, and I should have rolled it all the way up to 30. But I was a chicken shit, and I didn't. And I didn't understand the technology at that time. I understand the technology now. This stock is probably going to 100 or more, just based on how much money they're going to earn. People just won't be able to ignore it. Now, I'm going to give you a little secret about every stock on my list. Take a look at all the charts, and what you're going to find is that they all did really well in the last year or two. All of these stocks have been big winners recently. And that's important because the very most recent winners tend to continue until they get either so overvalued that it can't go up no more, there's nobody else to buy, or they fall because they just don't meet their earnings. There's a disappointment, and they get sold off 30% in one day because they don't meet their earnings. And you have to anticipate that. If you're keeping it up on your companies, you should know if they're becoming more or less likely to meet their expectations, because the market responds to expectations. It's not all about fundamentals. It's about the sentiment of the investor. It's about, is there enough people chasing that stock to keep pushing it higher and higher and higher? Or do eventually they stop chasing and the stock has to go back to them, right? So with end phase, you take a look at the weekly. Clearly not oversold on the monthly. Clearly not oversold on the weekly. Not oversold on the daily. Here, at the low, it just barely sniffed oversold. So this is probably a stock where on the daily, it won't quite get oversold. But on the weekly, so far it hasn't either. So we don't know that this will get all the way oversold. And at some point, you just have to ask yourself the question, is this stock so good that it's not going to get completely oversold? Is there always value buyers in this stock? I think that end phase is one of those companies that so many good investors know about now that when it comes down, they buy it. So we may not get true oversolds on some of these. A lot of the stocks on our list may not go all the way oversold all the way across the board. So when they get close enough, we have to just line it up the best we can and say, okay, what do the short-term indicators say? What is going to be that last down day or two or three? Last week on Monday, had that big sell-off. if you wanted to be an aggressive trader and get in and out over a few days, I mean, if I had bought last Monday, there's no way I would have still held on Friday. I had to sold everything Friday morning. And Friday morning is usually a good day to sell if you're on an up week, because there's a lot of profit taking Friday afternoon because greedy people wait until after lunch. Non-greedy people sell before lunch, and then they enjoy their lunch. All right, I'll take 2 or 3 questions, but like I said, I've been trying to keep these shorter. Would I advise raising more cash tomorrow? I don't know anything about you, man. Well, I do actually know something about you. I think the day to raise money was probably yesterday. So if we get a rally from the first couple days of the month, often rally. Why? Because retirement plan money often goes in start of the month. And we still have, more retirement plan money coming. It's kind of a weird year because of the extension. But in my opinion, I think that we're going to get a trickle in of bad news, both from executives and from the health officials, augmented by the horrible things that we're going to see on TV. That I think that April is going to be a pretty rough month. Jeffrey Gundlach came out and said the same thing today, all the same reasons that I gave in my article today, really. So I don't think it's time to buy. I don't think you're getting clear signals. I do think that, there was a hot minute last week where you could have bought some stuff, last Monday. But these are not generational buying opportunities. Not by a long shot. This stock market is still overvalued. And it would be unusual if this correction only came down here. So a new chart will be out in 2 days. And it's only going to come down to about here. It's not going to be way down here. It's going to be right here. Look how much this market was overvalued. So this needs to get down to this first line and below before I'm comfortable. And like I said, I don't know that it'll get below here just because of what the Fed and the government are doing. But below this line, that's really what you should be targeting for buying the market, the broader market, the QQQ and some of the other ETFs that we're looking at or that are on our short list. But as far as stocks go, you have to look at each chart individually. And this spot right here, that was the day that you probably could have bought this. You really had 2 days. Right? So you go to the daily. What day is that? March 18th. March 19th, 20th, 23rd. That was the last down day. So you had 4 days to buy it. Down around 40. Got your rally up to 50 something. And then you could have sold it. Today, there you go. That's today. My guess is you see Square go doink, doink, doink. And we get back down to around 40 with Square. And then the question becomes, does it keep on going? Right? Because it already broke through the support level. Will it go back under the support level and then keep going? We'll just got to follow these lines into oversold territory on the daily, but also on the weekly. You've heard me talk about weekly charts forever. The weekly charts, if you're a position trader, right, trying to hold for a longer duration, are the charts that you really have to embrace. You need good companies become oversold on the weekly chart to get really super long-term opportunities. Now, in a bull market, it's different, right? This isn't a bear market. In a bull market, you pretty much can just pay attention to the daily chart, and every time the daily gets around oversold, you buy it. That's buying the dip in a bull market. But the chart's not going up and to the right now. The chart is going down and to the right now. So the question becomes, how far down can it go? So somebody asked about oil. If you have a strong stomach You should be watching the oil ETFs, ETNs right now. It's better to trade futures if you know how to do it and you can handle the margin risk. But as soon as oil starts heading from contango and gets really close to backwardation, and that'll cost you a few dollars. But as the ETFs and ETNs, as oil gets into backwardation, which is going to take a while, then you can look at them. I sold some puts on some of that stuff just to start establishing positions a while ago, and one of them was really bad and the other one's okay. I think that oil is something that you probably don't touch for a little while. And Putin doesn't care about us, and the Saudis don't care about us. Don't fool yourself into thinking we have that much leverage anymore. Not over the Saudis. Not unless we're willing to do a war. The Saudis want the price of oil to go up because the Iranians are taken out of the game. So I made a chart. I built it from a spreadsheet. So I went and took the EIA spreadsheet and I put it out there. So this is an article that's coming out. But this chart, and I've been playing with it for a few days, shows what I think is the acceleration of the peak oil plateau and then demand destruction in oil. I think the price of oil gets back up to $40 a barrel probably by next year sometime. The only way it really gets much above that, because this glut is huge, is if there's a war. Or if there's tariffs. Trump could impose tariffs on oil. And I think there's a good possibility that we get either the tariffs or the war right after Labor Day, right, going into the election. Because clearly he plays up on this whole wartime president thing. So if he gives the green light to the Saudis to attack Iran, says, hey, we'll protect Saudi Arabia, that's what you watch for. So I don't think the oil trade is for now. I think the oil trade is a few months from now. Okay? So keep that in mind. But in any case, the whole stay-at-home economy is going to destroy oil demand growth. Oil demand growth, I took a look at the McKinsey report. I have that chart in the new article. All of the alternative scenarios, right? Everybody came out with 3 scenarios. The high oil usage, the base case oil usage, and the low case oil usage. Everybody's low case oil usage chart is now in play. And I think that most of them are still aggressive. So I shortened mine up. I think the oil is down to 70 million barrels a day by 2040. It's a 30 million drop. Now, the drop just for a quarter or two is going to be down to around 80 because of all the people staying at home. This is a good exercise in long-term reasoning, though, is if we can knock oil use down to 80 million barrels a day with half of the population not driving to work, what happens when everybody has an electric vehicle in 15, 20 years? It's the same thing, right? More fuel efficiency, a lot more EVs. EVs will be dominating the road by 2040. They're going to be leading in sales by the late 2020s. So, that's some things to keep in mind. That's half of oil use. The airplanes are getting more efficient. The ships are switching fuels. Trains are switching. Petrochemicals are changing because there's a replacement for oil as a feedstock and gas. So, technology is changing a lot of things. Ultimately, by 2050, I think that oil is a niche fuel, 30, 40 million barrels a day, and almost all of it's going to come from the Middle East, then some legacy wells, probably conventional wells that are just trickling it in. In our lifetimes, we're going to see oil go from being driver of the economy to just being just another little product. So, yeah, the EIA's projections have been crummy. you know, and I changed it. So from Kirkcast, the Kirkcast is from here out. The EIA though has gotten better. You know, clearly everybody realizes that oil demand growth is going to end in the 2020s now. Now the question is it 2025, 26, 27, 28, 29, 30, or all the way out to 2035, like some still think, or OPEC says 2040, or Exxon says 2040. Everybody's low case scenario that was already a reasonable low case scenario is more likely now. The high cases are just out the window. The base cases for the most part are out the window. What's happened with coronavirus is going to change the way that people work. I've talked to 30 or 40 people now. They're all working from home, and they say, oh, I don't know why I don't do this 3 or 4 times a week. In the future, they will. As long as they get the work done, right? And then people who don't get their work done when they're working at home, they'll just get fired because they can monitor what you're doing. They know how much work you're doing because you're logged into their system through one of these companies we talked about. So work from home is going to become a much bigger deal. One of the things that I think you should keep an eye on is single-family housing opportunities. If there is land near you that for some reason comes up for sale that can be developed, and it's only 5 miles from an urban area or 10 miles from an urban area, you should buy it if you can. If you can hold it for a while, because we need some obnoxious number. We need it's millions and millions of new houses we need. And think about all the people who are for sure not going to want to live in apartment buildings anymore. There's certain types of real estate that's going to suffer from this. Long term. Offices, malls. You see Simon Property Group, who I kept telling you wasn't as strong as you think they are. They laid off everybody. So, keep that in mind. In any case, I'll let you go. Another long one, mainly because of what's going on. As soon as things settle out in the next couple of months, we'll make these, 30-minute calls with 2 charts and, or 2 or 3 big trades of the week. And then we'll be done. But there's a lot of information still out there. And all I can tell you is the world is changing, and now it's changing way faster again. It's amazing. I told you in January after CES that the world was going to change faster than you think. Press the pedal down even further and harder now. Now it's turbo. Things are changing fast. And, as far as the oil goes, the pressure's building up, right? I thought there would have been a war already. I thought already Saudi Arabia would have attacked Iran, but President Trump says, wait, because I don't want the prices up. The opportune time, now that you think about it from a game theory standpoint, is for Saudi Arabia and Iran to have some fisticuffs after Labor Day. So that would be our oil trade. I will tell you, go on Twitter and start tracking down some of these feeds, right? Go on my Twitter page and find some of the guys that I follow where you can see that they have the Arabic written. You get great information. You remember I told you the next morning that the attack on the Saudi Arabian refinery was from Iran. It was missiles and drones. No. And then 3 days later, we found out, oh, yeah. How did I know that? I follow the right people on Twitter. Twitter is powerful if you use it the right way. So, all right, everybody have a great night. And I am going to call it a day. I have had enough. Take care, everybody.